Hi, everyone. I am Kirk Grantham with Catalyst Firm. Let's talk a little bit about the 2 out of 5 year capital gain exclusion. So I get a lot of phone calls from clients and they'll say something like this. Hey, I'm going to be walking away from closing with about 150,000 bucks. Do I need to pay tax on that? And the answer is one of those great accounting answers. It depends. And the interesting thing about it is that the formula for calculating whether or not you have a gain on the sale of the house is a little bit different than what you would think. So I'm actually going to switch to a spreadsheet and walk you through it directly. So whenever I get that phone call, my first question is this: what did you buy the house for originally? And then what are you planning to sell it for? And I'll listen for the answer, because there's a $500,000 capital gain exclusion for a couple or $250,000 capital gain exclusion for a single person. And so really the answer to that initial question can sometimes eliminate all other questions. So example, I bought the house for $950 and I'm selling it for $1.5. Well, immediately on that math, there's the potential for a $550,000 capital gain, depending on whether they're married or single or some other extenuating circumstances. Maybe they were married for part of the time. We could be dealing with a capital gain. So then we have to drill into some additional questions. So you'll see this at the starting point. Now, you don't have to only take the sale proceeds. So the $1.5 million sale price, you typically have to list with a realtor. You oftentimes are paying, maybe some concessions, and maybe you have some closing costs that you're paying to title and some other jurisdictions, right? So let's just say 6.5% is gone right off the top. So now we're at a $1,402,500 net sale price, $1.402 million, $500,000 net sale price. Now that against the $950,000 capital gain original price puts us at a place where perhaps they're below that $500,000 threshold. So there's a negative number here on the taxable gain. But let's say that that are a single person. And then my question is going to be, well, have you put any money into the house? And they'll typically say something like, well, I finished the basement and that cost me about $80,000. And then I also did some landscaping, or maybe $120,000, sorry. And then I also did some landscaping. I spent about $80,000 on that landscaping work. New deck, new concrete, perhaps some new shrubbery and things like that. So they had $200,000 of cost that they incurred while they were living at the house that added to their original basis. So now they've got an adjusted basis of 1.15. So the capital gain, $252,500, they have a capital gain exclusion because they've lived in the house 2 out of the last 5 years. Their capital gain is maybe $2,500. So not bad, right? So ultimately what we need to do is get someone to think through the mechanics of the transaction. You'll notice that I did not ask, how much loan are you paying off? It doesn't matter in this equation. I didn't ask questions about what is your net proceed amount. Yet you remember that from the original phone call that I received. Hey, I'm getting about $150,000 out of my house. That doesn't matter. And so when you have that type of framework, you're already coming about it wrong, and you need to kind of be thinking about this in the way that the IRS is actually going to be taxing you. This is what the equation looks like. So you do have to report this transaction on your taxes. We have to post some of this information on the personal home sale worksheet, and then we'll mark a box indicating that you lived in the house 2 out of the last 5 years. Maybe there's some small capital gain that will trickle out. Okay, so let's look at another caveat to this. So what if you rented out the house for a period of time? So today, as I'm recording this video, it's March 31st, 2026. Well, it's possible that maybe on April 1st, 2024, during this last 5 years, I rented the house out. Maybe even April 1st of 2023, maybe even the last 3 years. But if I'm within that 3-year window, I'm getting dangerously close to the edge of having lived there 2 out of the last 5. You see, this window is strict. And it is something that has to be adhered to. If you end up closing on April 10th, 2026, you've got a problem, especially if you rented this house out in a window where you haven't lived there for a period of time. So if you've lived there 4 years ago and you have a 1 year out of the last 5, you don't qualify for the 2 out of 5 year capital gain exclusion. We would use something else in that scenario, perhaps like a 1031 exchange. And just to be clear, a 1031 exchange is one of those things that people think about when they're selling a house. They'll say, well, it doesn't really matter about the capital gain because I'm buying another house anyway. No, that's not true. The capital gain exclusion is really following this formula strictly. So if you have an extenuating circumstance where you lived in the home and then you moved and you rented yours out, you've got to be thinking really carefully through this decision to make sure that you are not exposing yourself unnecessarily to attacks. So we always tell people, it's okay for you to rent the house out for a couple of years, but if you've rented it out for more than 3, you better be prepared to sell immediately at the end of that 3rd year so that you're still within that 2 out of 5 year capital gain exclusion where you've lived there for 2, rented it for 3, and now you're selling within that 5-year window. And don't mistake that as flexible in any way. So there's things like that can be really helpful. The IRS also has a publication, 523, that walk through different issues that may come. So for instance, like if you are going through a divorce and perhaps there's a step up in basis or something like that occurred through the death of a spouse, or there's some sort of extenuating circumstances that may have allowed you to qualify for a partial gain exclusion because it's a work-related move or a health-related move or unforeseeable circumstance because there was some sort of event that the IRS has described here. There's extenuating circumstances, but you have to make sure that you've got this thought through and correct so that you can handle it if it's audited. And the IRS could certainly audit this to test whether or not you actually had a reasonable circumstance that would have allowed you to take some sort of partial capital gain exclusion. So for instance, if you have lived in the house for a year and you've already made $100,000 on it, well, perhaps in that time you are moving because of a work-related move, and it can't just be that, hey, I just changed jobs. It has to be that you're moving to a new job or work location at least 50 miles further from the home to the old work location. I mean, the examples here are critical of like my old work location is 15 miles from the home and new work location is 65. Like, pay attention to these things because the IRS is serious about enforcing this sort of thing. So these are the types of things that may allow you to qualify for a partial capital gain exclusion. And there's nuance to this. But at the fundamental level, this is the way to be thinking through whether or not you owe a tax on the sale of your personal residence.